Welcome to the daily update, where I'll go over the action in the market for Tuesday, November 18th, and we'll see how things look for Wednesday, November 19th. Another down day, wasn't quite as negative as what we saw on Monday, but we're still going down. We're still negative in the short and intermediate term with the S&P. We did lose now the 50-day moving averages on the semiconductors. That's what I was really watching for Tuesday. And things are just not looking very positive. But there's some signs under the surface that there's some buying that was coming in, a bit of rotation going on. And a few of our charts actually ticked up a little bit with some of our indicators. And the big news is going to be after the close on Wednesday. NVIDIA is going to come out with their earnings, highly anticipated, could be a real catalyst to either get us to bounce up from where we're at right now and maybe turn things back more positive, or if the market doesn't like what NVIDIA comes out with, it could end up sending things lower. Now, another thing that happened in the recent past, I don't remember exactly when it was, NVIDIA did come out with a report and it was stellar. It was really good. Their earnings were good. The forecast looking forward was good. We really gapped higher that day, and that set the high. And then we came down, filled the gap, and then just kept going down after that. So even if they come out with a really good report and everybody's all excited about it and the futures are up pretty strong, just be aware of that things like that can and do happen. NVIDIA ended up closing up on the day, but gave up a lot of its gains on that particular day. But the rest of the market just really went down and it shifted everything to a more negative stance. So we just want to be aware of that. Now, the opposite can also happen, that if the report tends to disappoint and so we have a gap lower, that might be enough of a gap to see some buyers coming in and say, okay, enough of this damage has been done. Let's go in and do some buying. A lot of the smart money comes in and does that, and it ends up pushing prices up. So it's not always just a simple cause and effect. You know, the report's good, market goes up. Report's bad, market goes down. There can be a curveball that's thrown into that whole scenario as well. Now, before I get into the main part of the video, from now until the end of 2025, I have a program called the SPX Investing Program. It's free. Now, if you want to have access to the videos right when they're made available, you do have to provide payment information, but you're not charged anything. And then if you decide at the end of 2025 that you don't want to be involved with this, just cancel everything and no harm, no foul. Just check it out and see what you think. And just set up a time with me if you'd like to talk about things and we can get to know each other a little bit. I'm an educator, so I'm not a guru. I don't tell people what to do. I like to lead people into the critical thinking area of things and then develop a skill yourself. So, all right. So now, right at the open, we had a lower open. Now, the futures, when I started recording the daily video 24 hours ago, we were up with we were a little unchanged. And then after I got done, we were up about 0.5%. By the time I got done doing another video that I post on the website, we had gone down after that. So it's, yeah, kind of crazy. But we ended up having a lower open. The futures were looking okay, but then they started to drift after Europe opened. And by the time we opened in New York on Tuesday, prices ended up not really gapping down, but a lower open anyway. And we declined down below S1 at 66.23. Then we broke below 6,600. Tried to maintain that level. There was a bit of a battle going on right at that round number, but we did break down below that, and then we found support at S2. Didn't stay there for very long. And it looked like, okay, maybe things are shifting back a little bit more positive. And S2 was at 65.73. Then we climbed back above 6,600 and S1. So it's like, okay, maybe there's some kind of a rebound happening here. Well, that didn't go on for too long. Prices then declined. We kind of stalled out there. And then we came into the afternoon part of the day. We declined and retested 6,600. So now that ended up being support. Even though we broke it earlier in the day, that's about as far down as we went later in the day. And then we advanced above S1. And then we chopped along the 66.50 level. And then here, this is when things shifted a little bit more negative going into the close. We saw some late day selling and we ended up closing down below S1. All right, so we were down 0.83%, not as much of a decline on a percentage basis as what we saw on Monday, but still pretty substantial. It's like here we are in positive seasonality and we keep going down. Well, there's a lot of things hitting the market right now that's causing a lot of concern. And we've been seeing this building up over a number of months, and now it's finally starting to play itself out. We're trying to figure out, okay, how long is this going to end up lasting? And we were still below average with volume. So not by very much, but just a little bit there. And we are now negative in the short and intermediate term. We've been negative in the short term for a while. After Monday, we switched to negative in the intermediate term because we're below the 50-day moving averages. And we're still positive in the long term. Interest rates not really moving all that much, and not really all that much news coming out that is having a direct impact. Now, and we're starting to get a release of some of these economic reports, but it's like, okay, what are we going to get? How old is it? How much is the market going to actually pay attention to it? Yeah, yeah, yeah. All right, so mega caps and tech didn't have a good day. We're still seeing some money coming out of the whole AI area here. And I saw one comment from Edward Yardeni that this is an AI generated decline. I mean, it's kind of a play on words there. So anyway, the mega caps and tech, they're out of favor currently, but at some point they're going to be low enough where folks are going to want to come back in. We're just not quite sure when that low enough level and is at. And then we're still below the 50-day moving averages. Now, there's another type of moving average called a volume weighted average price. I just call it a volume weighted moving average. And or it's an anchored moving average as well. And I have a chart of that. And we're holding at that level. We're below the 50, but there's a shorter term other kind of moving average that we closed right on that. And so that's giving us a little bit of hope right now that there's some areas of support that are still holding for right now. But the semiconductors are still weak. And so we'll see if some buying eventually comes back in, but they're turning more negative. And we're getting up into the 24 range. We're at 24.69 with the VIX. So we're well above 20. And this is when things tend to turn more negative. When the VIX goes above 20, we still have this confirmed Hindenburg almond lingering in the background. And then on a short-term basis, we're seeing pretty substantial negative conviction here. Now the VIX, based on 9 periods, we shot up to go up to 24 with the VIX quickly, like we did. Yeah, that's going to cause. There's an RSI that I use on this to say, okay, we've gone pretty far, pretty fast. Doesn't mean we have to stop there. We just start paying attention to it a little bit more when it sees a high reading. Just means the VIX is climbing really quickly. And then the Carner's RSI, this has been on the list now for 2 days. It's looking extreme negative. And then we have our usual charts that show positive or negative conviction. In this case, it's negative conviction. The Stochc RSI, Williams percent are both CCI charts and the stochastics. Those are the usual charts that we see. Now we're seeing a little bit of an extreme reading with the force index. There's Keltner bands on that chart, and we're hitting the lower Keltner band, which are very similar to Bollinger bands. And believe it or not, it seemed like forever we were too far away to the upside from the 20-period moving average. Now we're getting pretty far away to the downside from the 20-period moving average, and that's what the boom indicator measures there. Intermediate term, we only have one thing, and it's not in the S&P. It's the NASDAQ 100. The bullish percent index is starting to get extreme negative. We're right at 30, and when we get to 30 and below, that's an extreme negative reading. So we're still seeing some more weakness there. All right, no change to the overall scenario. The rate cut is still right around the 50-50 mark that there's going to be a rate cut in December. The dollar was up and interest rates were down, but not by very much. We closed at 4.12% with the 10-year yield, where we were at 4.13% after Monday. All right, and then now I was watching this too. When we closed up off of the lows in Tuesday's session, but when we were down at the lows, when we were testing S2, we were at 9 with the sentiment. I mean, we don't see single digits very often, but hey, there's still room to go down to 0 here. We are very, very negative. We get we see this as extreme when it drops below 25, and then we came down to 15. Now we're at 11. Intraday, we were even down at 9. My goodness, you have folks that are very pessimistic right now and doing a lot of hedging. And we are trending in the short and intermediate term, and it's a negative trend because we're above the moving average. We're still below 20, so it's not a confirmed trend. And with the down day, the bias is negative and the momentum is negative, and we're also trending in the short term as well. All right, so now we got some reports out here. Now, my charts that I show for this didn't update, so I'm not sure what's going to happen with all of that. I have the charts through stock charts. They let you chart the initial and continuing claims, but those charts didn't change. They still are from last September. So the initial claims that we did receive came in at 232,000, which is at the higher end of the range that we've been dealing with here. So that was a little weaker than expected, and the prior reading was at 219,000. The continuing claims went up a little bit there too. We're still below that 2 million mark, but we're at 1.947. I mean, we're just right underneath that, and that climbed from the 1.916 million. And then we did get factory orders, which came in up 1.4%, more than the 0.8% they had expected. Last time it was down 1.3%. And then the NAHB Housing Market Index came in at 38, which was stronger than the 36 they had expected and up from the 37 that we saw last time. So I don't have the initial claims charts to show you. I would get them from briefing.com, but when you go into the whole COVID thing, the charts are so skewed, they're pretty much useless because everybody got unemployed all at the same time there. So when we look at the year-over-year factory orders, just slightly above zero, and it did advance here. And then the durable goods also above zero and showing a bit of a tick up there. And then non-durable goods orders pretty much flat, still slightly above zero. Non-defense capital goods, you take out aircraft for that one. It did come down, but it's still above zero overall. And then the NAHB Housing Market Index is going up here a little bit, seeing a little bit of a rebound there. All right, and then every week we get the overbought, oversold composite. This is bigger picture. I look at daily charts and I usually look at indicators one at a time. This is more of a composite. We're coming down, but we're still getting a high reading. We're still red. We're still at the 78.93 level, near that 80 level, but it is coming down from the reading that we were seeing earlier on. And then discretionary investors, they've cut back their positioning. All right, so they're starting to come out. And I keep showing these. There's the discretionary, and then there's the systematic approach, and all of that. Folks are getting more bearish because these are folks that tend to be making more decisions based on what's happening under the current market conditions. And then looking at what's the probability of going into a recession in the next year, still very low at 15%. And based on different market instruments, are we in a recession right now? Only 3%. So you could say no. The odds don't favor that either now or in the future. And then healthcare positioning. This has been an area that's seen a lot of love lately. A lot of positioning is coming back in. A lot of people are buying into that, which still, the companies may be good in there. They're having some good earnings. They got hit a little bit on Tuesday. Um, but this is also a defensive area too. And so if this area is starting to come on a little bit stronger, that could be the market shifting more over to a defensive posture rather than just necessarily being what some folks are perceiving as a good investment. And then we get this all the time. We're overvalued. NASDAQ 100 PE ratio at 29. I discount this one, the Russell 2000, since it's calculated different. I use the S&P 600 small cap index, still coming in at 23 with the S&P. The equal weight is at 17, and mid caps are at 16. The PE ratio for the small caps that I use, it's down here with the mid caps in the more fairly priced area. And then performance of AI exposed equities coming down right now, after really just skyrocketing up here. And then enabled revenues are also dropping off here. Productivity just kind of not really moving all that much after it had been declining. Strong positive earnings sentiment. Well, okay. Now this is world, and we have the S&P, the dark blue, and the earnings still look the strongest. This is how people are feeling about earnings right now, and they're tending to go up, even though I believe this is the emerging markets here actually declining a little bit there, and that index has actually been holding up better. And then warn notices, notices of impending layoffs spiked to 39,000 in October. This is from the Cleveland Fed, and we've only seen it back in 2008, 2009, 2020, May 2025. Not so sure about the May 2025 part, but those other times were not really good times for employment. But we're seeing that going up here. Just notices of mass layoffs that might be happening. And then the next Fed chair, who do you think it's going to be? Roll the dice here. And we have Kevin Hassett, who's kind of breaking up. Now, and there are these betting sites that you can go to that you can actually bet money to see who's going to happen. You can bet on sports, dog races, how fast trees grow, what shape clouds are, whatever. But this Kevin Hassett's looking more, at least based on this. All right, and then Bitcoin ownership, we're seeing bit of a drop off here, where in 2024, actually, we were seeing more retail folks, and now in 2025, we're seeing more institutional. So no, it's not a drop off. It's just this is in a different order than I would normally put it here. But we're seeing more institutions owning this, and it's like Bitcoin's really having some problems right now. I do have a chart later on to show you. It's not because of Bitcoin, it's because of how it impacts the Nasdaq 100. And then tech spreads, these are getting pretty low right now. The investment grade tech spreads, they're wider. Then this has to do more with the debt that they have, wider than the broad index for the first time since blah blah. So this could be some risk coming in here because there's all this money going into these different areas, especially AI. And there's been some reports and some things that I've heard about that big companies are assuming some debt that doesn't necessarily show up on their balance sheets. Well, pretty soon the market's going to get wind of that and say, well, okay, you look at your balance sheets and everything looks fine, but what about this stuff over here? And that could cause some concern. So anyway, but this is kind of speculation here. Um, anyway, let's go back and talk about what happened. So we did have a lower open. And it looked a little positive going into the close on Monday. This is when Fed Governor Waller came out and said, well, I might vote for a rate cut in December. And this also was a technical bounce after we had been coming down pretty good. But there was really no follow through into Tuesday's session. We gapped down, we dropped below S1. This is the 6,600 level. And we fought it out there for a little while. Broke down, came down, broke down. And then we finally broke almost down to S2. And that set the low for the day. And then from there, it tried to go back up and it looked like, okay, maybe we're going to get a bit of a bounce here. But we just stalled right back above S1. We came down. Then this is later in the day. This is now the afternoon. And we came back down to the 6,600 level. We didn't break below that. We were able to come back from there and we got above the 6,650 level, chopped on sideways. Then the things that were a little bit more negative, this was the late day selling that took us into the close, and we ended up going down below S1. All right, and then not much of a change with the initial overnight session here, but we're seeing most of the price action actually happening while the market is open. And but we're getting gaps here and there, but we're still seeing a lot of follow through once the market actually starts trading. But we were doing better here with the futures, and then they started to really come down, and then tried to recover during the session, but just really had some problems there. All right, and then we're still seeing a gradual drop off here with the intraday growth to value or growth and value charts for large caps. They are coming down. The bigger picture is that we haven't really broken this trend. It's looking a little vulnerable here, and it's certainly showing some short-term weakness, but it hasn't really started to really move to the downside with a lot of conviction. And we're still seeing the red line above the blue line, which means the value is outperforming growth, at least on an intraday basis. This is not showing a lot of strength right now, but not necessarily a lot of follow-through weakness, where we are coming down with the growth to value ratio for the S&P. But once the market opened, we pretty much went sideways with that. So end of day, we were down more with growth with the large caps than we were with value. Now the mid caps were actually up, but the growth was up less. And the small caps, we did see the growth was up for the small caps where value was down. So not really much of a change here with our small cap growth to value ratio. It was looking really strong and now it's starting to pull back. The bigger picture is it's still positive, but mid cap growth to value, not very good here. It's still below the moving average, and we're still seeing a continuation of a decline here with S&P growth to value. And this is what we've been seeing going back into August, and it's still trailing off here, and that's not really positive for the market. All right, and we're still coming down a little bit more into the rainbow with this growth to value ratio, and we're falling down below the 50-day moving average with discretionary to staples. And we're holding out above the 100-day moving average here with the large cap growth ETF. We haven't quite come down there yet, but we are below the 50-day moving average. That was lost on Monday, and it continues to be lost after Tuesday. And this ratio is going up, but remember the bigger picture is that the value has been underperforming the tech sector, but we're seeing a bit of a bounce up here as the market's been getting more defensive. And I put this in a different place this time because this is more of a growth to value type of a thing. But you can see the weighted version of discretionary to staples going down, the equal weighted version going down, tech to utilities going down. Now, the biotech to healthcare, because healthcare has been doing okay here, that's holding up all right. And then we're starting to roll over when we look at hotels to utilities. The ones that really have the biggest impact on the market would be discretionary to staples and then possibly the tech to utilities, because those are pretty big areas right now. And then as far as our trend, we are negative in the short term, above the moving average, going up. We're still below 20, so it's not a confirmed trend. It's negative with the red line going up and the green line going down. Also above the moving average in the intermediate term, still below 20, but it's negative with the red line above the green line. And we were less below average here than before, but we're just a little bit below average with volume. Now we're negative as far as the gamma exposure. This whole chart is red. If there were positive areas, part of this chart's on the right-hand side would be green. It's not. We closed around the 6617 level, so we were able to get back that 6600 level in Tuesday's session. But now we're starting to see the 6600 level come into play. Now, we broke below that intraday, and then we bounced off of it later in the day. So this is still acting as an area of support down here. And if we go up, of course, we'll be watching the 6650 level. It's not quite down to this blue line. And then here's why 24 VIX is no fun, because that's when we see negative annualized returns, according to Schroders. Isn't he a piano player? And the Ulcer Index ticked down a little bit, but it's still above its moving average. Fear coming back into the market there. We're above 20 and climbing with the VIX. Now we closed a little bit off of the high here, but still we're at 24. It was a lot higher when we were headed lower and during the session because we did come up off of the lows here. But this is when things turn more negative. And here's the VIX with the RSI here. We're above the 70 level. That means that we've shot up pretty quickly. Doesn't mean we have to stop here. It could still go higher than where it's at, but this is when we start to pay attention to it. And when we're above 20, this is when we see negative annualized returns for the VIX based on the research that Tom Bally did. All right, and then the VIX of the VIX, the volatility of the VIX, it's really picking up too as the VIX has become more agitated these days. So we're going up with the bar chart and the line chart. And then now we're seeing more confirmation here. We're increasing with this fear gauge. We're also going up with this other fear gauge. And we're just seeing a real big upward move here with the daily equity put call ratio, which is more negative. A lot of hedging going on. And we're really shooting back up with the 5-day chart and the 10-day chart. And we're coming down here with the risk on to risk off ratio, but still the bigger picture is that we had been going up. And we'll continue to see if this continues to fall, then yeah, that's going to be more negative. But the bigger picture context is still positive. And same thing with the high beta to low beta ratio. Bigger picture, it's still looking positive, even though we're seeing some weakness now. And we ticked up a little bit with the momentum stocks here after they had been trailing off. But this broke down out of this range when we do a ratio between momentum stocks and the S&P. And so we'll have to see. Now, the one thing that's different about this is we're declining here, and we're seeing momentum stocks going out of favor right now. When we were really declining back last spring, this ratio was really going up. So we're kind of seeing the opposite of that right now. We'll see how that plays out. And a bit of a pickup now with the volatility risk premium. This has been rather tame and we've been staying within this range. Well, after Tuesday, it's starting to climb up there. And we are kind of pretty much flat here with the advanced decline line based on price. Now, we have been declining, but the reading from Monday to Tuesday didn't really change all that much. And we are declining a little bit more, but in the bigger picture, still positive with the advanced decline line based on volume. And we ticked up a little here, but we're still negative with the advanced decline ratio short and intermediate term. Ticked up a little bit here, but still below zero with the advanced decline oscillator. And we're finally starting to roll over here a bit with the 5-day and 10-day chart of the new highs, new lows. We're seeing a drop off in the new highs, even though they came up a little bit on Tuesday. We're seeing more of an expansion of the new lows. And we're negative with our three smart money indicators. We're right on the moving average with accumulation distribution, or the boom indicator shorter term. That's continuing to be negative. Now we are dropping below this green area, but again, sometimes we get a little concerned about this, where sometimes it matters, but other times it doesn't seem to matter all that much. And we're negative with the Chaikin money flow. The red line's going down. The histogram is not doing very well. We're declining and starting to drop below the midpoint with the Chaikin oscillator. We're negative with the vortex, the red line going up, the green line going down, and we're below the moving averages. But you can see here a little bit of a tick up with the advanced decline line studies for the NYC common stock, but we're still below the moving average. We were flat with the S&P below the moving average. A little bit of a tick up with the mid caps and small caps, but still below the moving average. And a little bit of a tick up here with those stocks in the S&P above their 20 period moving averages, but we're still negative overall since we're below 50. And a little bit of a tick up with the 50 period moving average, but still below 50. And came down a little bit with the 100-day moving average study and a little bit of a tick up with the 200 moving average study. Now, this is still positive since it remains above 50. All right, then the short term. Now, we came right back up to this pivot point here. And so we broke below that. I was pointing that out. That support didn't hold for right now, and we're coming right back up to it. So we're just a little bit below it for the time being, but we still remain below the 50 period moving average. Now, this has us a little bit above average with volume here. So it's a little bit of a discrepancy there. And we ticked up just a little bit, but we're still negative in the bigger picture with the 20. We were flat with the 50, and we're turning up ever so slightly with the 200 moving average study there. Now we look at the short-term conviction. Negative with the Stochk RSI, extreme negative with the Williams percent R, the CCI 14 and CCI 20. And then we're hitting the lower Keltner band here, which again are like Bollinger bands, and we're looking a little extreme there. We're extreme with the short-term stochastic, and then this is just a further subdivision of the short-term time frame, where we're declining, but not quite extreme with the intermediate short-term, and we're declining and still above the midpoint with the long short-term stochastic. Short term here with the 10, 20, and 30, the lines continue to come down as price is below all three of those moving averages. And more vulnerability here with the short term trend. The green line and the blue line are going down, and prices below both lines. This is the anchored weighted moving average that's held right now. We fell down below it. We closed right on it, which is really kind of strange here. So we're at 66.17 right now. So this support level is holding. Are we going to get enough of a bounce up off of that? So we don't know. We'll see what happens there. Now, if we do start to fall, there's another anchored weighted moving average here down around the 65.26 level. And we're falling below the rainbow. The longer we do this, the more these lines are going to start to roll over with the short-term rainbow. And we're still in the -2 channel with the standard deviations chart. Now, intermediate term, we actually are leveling out here with the balance of power, but we're still negative overall since we're below zero. Extreme negative with the Connors RSI, even a little bit more so than what we saw after Monday. Negative with the go, no go with the brown bars. And we're still hitting the lower low value here with this chart. That's more negative. And it's still an uptrend here with the proper order. Okay, it's like I'm still gonna be positive for now. But we're drifting even more negative with the TTM squeeze. We're starting to move rather quickly, and the standard deviations chart is picking that up. That's why we're above the moving average. And again, this measures speed, not direction, and it has us moving pretty fast. And not much of a change here. Still positive in the bigger picture with the Arun. We're above zero with the oscillator. A little bit of a tick up, but still below zero with the S&P McClellan oscillator. So we're declining with the summation index based on price and volume. A little bit of a tick up here with the NYSE McClellan oscillator, but still negative. So we're declining with the summation index based on price and volume for the NYSE. And continuing to decline, seeing a little bit more conviction now with the ease of movement that's showing more negativity. And the Swelling Trading Oscillator, we're declining based on price and volume. That's negative there. Momentum is negative with the PMO going down. We're dropping further below the moving average based on price and volume. So we actually ticked up just a little bit. See these little ticks of improvements that we see along the way? Not enough to change anything, but for as much of a down day as we had, you wouldn't expect to see these little tick ups here. But we're still below 50 with the PMOs in the S&P that are rising. We're declining with the buy signals. We're leveling out with the PMOs that are above zero. And negative with the Elder's Impulse system for the S&P as well as the parabolic SAR. Negative with the short-term slope oscillator. Negative with the MACD. Starting to come down to the midpoint here, which might turn things more negative. And all of our momentum oscillators, short, intermediate, and long-term, are all negative, as is the Copic curve. Declining here with the Sean trend meter, the context is negative there. A little bit of a tick up, but still below 50 with the money flow, and we're starting to drop below 50 with the ultimate oscillator. Declining, but still above an advancing moving average with unbalanced volume, and declining below 50 with the intermediate term RSI and the short term RSI. If we see a little bit more of a decline here, we might go extreme negative, which would be the first time we've been seeing that since we had all the trouble back last spring. And we're still declining with the bullish percent index, below the moving average, below 50 and declining. That's negative. We're below 50 and declining with the NYSE bullish percent index, and we're starting to get extreme. This is the one I had on the list. The NASDAQ 100 bullish percent index is right down at 30. Now it can drop a lot below where it's at here. This is just when we pay more attention to it there. And we're declining and seeing more vulnerability to the intermediate term trend. The red line, blue line going down, prices below both. And we're below the 50 period moving averages now. But then you go to Bloomberg and they're like, this is before Tuesday. We lost this on Monday, but they're coming out with a chart here saying that we're still holding above the moving average. No, we're not. We didn't. So be careful of these charts. If you go to, and I'm not just singling out Bloomberg, but that's why I chart things myself. If I make a mistake, at least that's on me. But if I'm looking at a chart like this is giving me a false story. So be aware of that because falling below the 50-day moving average is a big deal. It shifted the whole intermediate term trend over to negative. Now, am I splitting hairs on this? Probably. But, you know, just be that's why I look at a lot of different charts to see are we getting a confirmation? Because we can get some kind of an outlier, some kind of a strange reading that we make a decision based off of, where if we looked at more information, we might not have reached that same decision. All right, and then we're going to be watching the 100-day moving averages in case we come down to that level. And here's the intermediate term rainbow. We're coming into it, but we haven't been here for very long, so the lines are still going up. So we're below the 20s and 50s. We're still above the 100s, and we're still well above the 200 moving averages. We're already getting kind of far away to the downside from the 20 period moving average. See the boom indicator is starting to look extreme. We're below the midpoint because we're below the 50-day moving average, and we're seeing some weakness, but not down to the zero level here with the 200-day moving average study. And then we're coming into the cloud. Where is the cloud? And we're looking more negative. The green line, which is almost impossible to see, it's negative. It's going down. We're dropping with the blue line below the red line. That's more of a crossover. That's intermediate is blue, long term is red. So this is turning more negative, and we're going to see, are we going to find some support inside the cloud? And now we're seeing a little bit more vulnerability here with I've been trying to point out the higher highs, higher lows. That's kind of a little bit in jeopardy right now. So we'll have, again, this isn't an official chart until we close on Friday since it's a weekly chart. And we're negative with all of our trends here. The Heiken Ashi is negative, the Kigi chart is negative, the Renko chart is negative, the three line break chart is negative, And we had enough of a decline when we dropped below 6,600. We had a new O drawn in here. We have a double bottom breakdown. Yeah, sounds like a dance. So this is looking a little bit more negative from a point and figure standpoint. All right, and then we're just barely above the midpoint with the 150, and we're more further above the midpoint with the 200 moving averages here. And negative in the short term, and I have us negative in the intermediate term too, but they don't here, where the mid caps are negative in the intermediate term as well. And bonds are still negative in the short term, and we're still positive in the short and intermediate term with the dollar. And so we saw a bit of more of a split here where energy ended up being up, healthcare, those are defensive areas, but then communication, all right, that's a growth area. But then staples were up, which is more defensive, real estate's more defensive, materials saw a little bit of a bounce. Where at the bottom here, the things that got taken out the most as far as the decline, tech and discretionary, they were down the most. So a lot of red here. Did have a utilities BPI cross above 80, but the financial sector it's crossing below 50, and we're still concerned about that. Canada has seen better days recently up there with the TSX, and then we just count down with the Nasdaq 22, 7, 6, 5, 4, 3, and that's about as far down as it went. And we did go below 6,600 with the S&P. We were able to get that back later in the day. The Dow now crossing below, first below 47,000, then I guess this is later on. First below 46, then later before 47. Go figure. And then we had a BPI cross below 30 here with the communication. So even though it was up, and this is a huge growth area, it's not looking all that great technically right now. An awful lot of red here. NVIDIA, and that's the big story stock. Microsoft ended up going down. And the big outage with Cloudflare, I got directly hit by that. And it was a monster of a thing to try to work through. And I assume a lot of you had to deal with that too. But you can see over here with tech, NVIDIA, Microsoft, Broadcom was down, Oracle up just a little bit there. And then communication with Netflix up. They have like a 10 to 1 stock split or something coming along there. And so that giving a little bit of a boost that way. But you see discretionary, Amazon and Tesla were down. So those areas are getting hit. A lot of green in healthcare, but we saw a bit of a hit here with staples as well. That's Walmart. All right, and I wanted to point this out. Where we're going down with the S&P weighted index, we're flat now with the equal weight. So the equal weight is holding up a bit better. And the little tick up that we're seeing in some of our indicators, it's coming from the equal weight side of things. And we're starting to go back up a little bit here with the equal weight to S&P ratio. Now, bigger picture, nah, the equal weight is underperforming. But lately, this has been bouncing back up as we've been going down. And we're still below the 50-day moving average. We closed just barely above this S1 level with the Dow, but we are negative here in the intermediate term because we're below the 50-day moving average. And it was just a week ago, less than a week ago, we were setting an all-time high with the Dow. And we're negative with the diamonds. I'm looking at the Elder's Impulse system. We're dropping further below this S1 level and further below the 50-day moving average with the NASDAQ. And negative with the Elder's Impulse system, dropping further below this S1 level with the NASDAQ 100, also below the 50-day moving average. Negative with the Elder's Impulse system. Momentum for the NASDAQ 100 is negative. We're still below both of the moving averages, the 20 and the 50 here with the QQQs. And then small caps, they actually held up pretty well. They were virtually unchanged on the day, holding at this S1 support level, and not really. They were actually up with the Russell 2000 small caps. They were up a third of a percent, but still negative with the Elders Impulse system. Mid caps, they were up a third of a percent, but still below this S1 support level, still below their 50-day moving average. Negative with the Elders Impulse system. The Wilshire still falling further below the 50-day moving average. And the financial sector, it's still holding out above its 200-day moving average, but not by very much. And it was down fractionally. And we're still going down with the financial sector to S&P ratio. And we're seeing more weakness here with the ARC FinTech Innovation ETF, still above the 200-day moving average, but we're below the 200-day moving average when we look at the ratio between the ARC FinTech ETF and the S&P. The banks were able to get slightly back above their 200-day moving average after losing that in Monday's session. And FANG index further below its 50-day moving average. So Apple was virtually unchanged. Amazon down 4.43%, dropping below its 50-day moving average. Down 2.7% with Microsoft. And Google, it was virtually unchanged here, just kind of chopping around right now. Meta, it's been seeing some weakness, but it wasn't down that much, 0.72% here, below its 200-day moving average. NVIDIA, this is the big story. It's down below its 50-day moving average, down 2.81%. And Tesla, it's down below its 50-day moving average as well. And then Netflix was up. So we're starting to reclaim the 200-day moving average here. Then the Dow Jones Semiconductor Index, this was the area of hope that I was pointing out after Monday. We were slightly below, above the 50-day moving average. Now we're slightly below. Now we can get that back. It depends on how long are we going to stay here if we do bounce. Or is this the beginning of more of a decline that's going to come after this? Maybe what will happen after the close on Wednesday will bring some light into that. And then it's going to be follow through into Thursday's session. Also, down below the moving average now with the SMH semiconductor ETF, where we were slightly above it after Monday. And so we're coming down. We're just a mere 100.29% above the 200-day moving average with the weekly chart of the Dow Jones Semiconductor Index. But the reason we're watching this is not because of the crazy percentage, it's because of where this is at and where a lot of times this has a tendency to top out. And then here's the SMH semiconductor. We never did get up to this 100% level here, but we are declining with this weekly chart as well. Now, bigger picture, semis are outperforming tech, but we are seeing a pullback right now. And here's Bitcoin starting to go more into a downtrend and getting into the low 90s. And the reason I'm looking at this is because of the correlation between Bitcoin and the NASDAQ 100. And the correlation is still remaining pretty strong. And we're going back up here with the staples to tech ratio. That's defensive. But the bigger picture is that this ratio has been coming down. And then we look at these bellwethers. We're dropping off with the semiconductors, home builders, transports, retail, regional banks. So we're just seeing across the board weakness right now. And oil was up. We're getting back up into the 60 range, and we're still below the 100 level. We were up slightly with the US dollar index daily chart, and not really doing all that much here with the 10-year yield, not really moving all that much, still above the 50-day moving average with the 10-year based on price. And we're still seeing weakness here with our growth to value ratios. Qs to S&P, discretionary to S&P, large cap growth to large cap value, and below the moving average with the large caps, mid caps, and even the small caps. And still going back up here with the staples to S&P ratio, but the bigger picture is that this ratio has been declining. And then we have the Hindenburg Omen, and if you hear a sound behind me, I apologize. It's some heavy machinery here. We don't have another spike, but we do have a series of spikes that have been accumulating here. And that's when we want to pay more attention to this because that's similar to what we saw before the COVID crash and before the bear market of 2022. These singular spikes along the way, they wear out after a while. And then looking at the outlook, NVIDIA, that's the big story. But then we'll have to see how the future reacts, then futures react, and then what happens with the stock itself, and then what's going to happen with the open on Thursday. But we are negative in the short and intermediate term. We're still long-term positive. I have no idea about there's stuff that comes up. I go to briefing.com, I go to investing.com, and I get different information from both places. So we're just kind of waiting to see what ends up being released here. And then anything geopolitical that may or may not happen here. And then that's why this is all blued out because I'm just kind of giving up on the economic reports for right now. Now, as far as seasonality, not very good for November 19th. The Dow is negative and we're neutral to negative for the S&P and NASDAQ. We are in the middle of options expiration week, which tends to be up more than down. We're going to have some heavy work to do if we're going to go on the side of being up. And then here looking, we do see some negative seasonality even during post-election years before we see a little bit of a bounce going into the options expiration day. And now we're into the second half of November, which is supposed to be performing better than the first half. But yeah, tell that to 2025. And then again, just to show that we typically have positive seasonality here, positive seasonality here, positive seasonality here, positive seasonality here, but it's just not playing out this way now. And this also shows the statistics for November. All right, so the negative side, our three smart money indicators are negative. The short-term growth to value ratio is not looking really good. Discretionary to staples, not looking very good. Longer term, they're still in uptrends. The Swelling Trading Oscillator is negative, as is the Parabolic SAR, the Money Flow, and Ultimate Oscillator. The Momentum Oscillators are not positive now, they're negative. And then we're negative with the McClellan Oscillator and Summation Index for the S&P and NYSE. And the ease of movement, and then the bullish percent indexes are negative as well. The vortex is negative, and the momentum for the NASDAQ 100 is negative, and we still have this confirmed Hindenburg omen that's lurking in the background. Positive side, bigger picture, we're still positive with our trends with growth to value and discretionary to staples. Financial sector is still in an uptrend, but it's just really underperforming the S&P. And longer term, the daily and weekly special K charts are still positive there. Not a lot to hang on right now. Now, one thing I wanted to point out here, this is posted on the YouTube community tab. We did hold right at this pivot point here. Now, these are different pivot points. There's standard ones, there's DeMark pivot points. He's like a rock star when it comes to technical analysis. And then there's the Fibonacci pivot points here. But we closed right about on this level where sometimes these, that's why I put all three on here. So it just gives you kind of a buffet of different pivot points. And then here are the pivot points for Wednesday's session. So our conclusion, we're still negative in the short and intermediate term, positive in the long term, and we're just continuing to see this negative momentum building in the short term with a new trend that's been developing. Also seeing a trend in the intermediate term with weakness continuing to develop there. We're still positive in the long term. Thank you. I hope you have a good day, and I will talk to you in the next video.